Yet the title of my presentation is Bitcoins, Gold and Silver, Once and Future Money. I'll briefly deal with Bitcoins first before moving on to gold and silver. Hold on, let me get this thing working. There we are. Bitcoins, as I understand it, rely for their value on a known quantity of supply, an assumption that that supply will be matched by demand. This isn't a recipe for a stable measure of value. So on those grounds, as this chart shows, I can hardly recommend Bitcoin as money. In this chart since January, that is in the last 5 months, they've risen from about $12 to a high of just over 260 before collapsing to about 50, and we're now pausing at about 130 before the next move. I would have great difficulty in my mind buying something for, say, 100 Bitcoins only to find 4 months later that the price had dropped to 4.6 Bitcoins, only to rise again to 24 Bitcoins before falling back to 10 Bitcoins. And this is actually what this chart tells us has happened. Most of my problem would be trying to judge whether I should hang on to my Bitcoin money or not. Admittedly, some of the recent volatility may be the result of US Homeland Security closing down money transfers between Mt. Gox, a Japanese-based Bitcoin exchange, and its payment processors. But that is a sharp warning that however clever a new electronic currency might be, if a government decides to shut it down, it will shut it down. But if other people want to use it as money, knowing this risk, I see no reason why they should not, but speaking personally, it's not for me. I now want to turn to a far more important subject, and that is, will gold and silver become money in the future? And to answer this question, we've got to look at the role of money in society and its necessary characteristics. What is money? We have to understand why people use money and look at it from their point of view. It is, after all, at the heart of social action. We must compare the qualities of gold, or silver for that matter, with those of government-issued currency as money. Incidentally, I saw a distinct... hold on, let me go back. I'm ahead of myself. Incidentally, I do draw a distinction between money, which has always been chosen by society, and currency, which is a money substitute imposed on society by government. The reasons for this distinction will hopefully become clear in the course of this presentation. Money evolved to address the problem of coincidence of wants that arose from barter, and barter could only take place if the parties to a transaction could exchange their goods on a mutually agreeable basis. If that was not the case, there was either no transaction or at best a very inefficient one. Money has to be the objective value in a transaction, so that price has to reflect the subjective value of the goods and not money. Money must have no price, so the price is entirely in the goods and services changing hands, not in the money. It follows that a unit of money today has to be the same as it was yesterday and the day before that, and so on and so forth. It has to be constant. That is why we always say that the price of whatever it is we buy has risen or fallen. We always impute price changes to the good or service being exchanged, not to the money. Money has to be accepted as money by all those we exchange goods and services with. Originally, it would have been the other members of our tribe, or in my forebears' case, the clan, or community. This was the origin of city-states in the Middle Ages. They were economic units, if you like, trade units. And as trade developed with other communities, a common medium of exchange, or money, had to be acceptable to them as well. Therefore, money evolved to satisfy the commercial needs of society. True money is chosen by society. Many forms were chosen, but none have endured as long and as widely as gold and silver. Also, stable money became invaluable for merchants keeping records of their transactions, their costs and profits. These become meaningless unless money is both durable and stable in terms of what it buys. I referred to the requirement for money to be the same yesterday as today, or for its use value to be constant. To validate this constancy, we have to be able to establish why throughout history we trusted gold and silver as money, why they have that function. And here we can go back to the dawn of civilization to confirm this. This slide is of the Alfred jewel. You can see it in the Ashmolean Museum in Oxford. It's Anglo-Saxon, and the inscription translates as "Alfred ordered me made." It was discovered in Somerset near Athelney, where King Alfred founded a monastery, and it is over 1100 years old. This is an object of great beauty, and it is as new. It has not deteriorated one iota, and I defy anyone who has a human soul not to want to touch, to feel, to own a jewel like this and value the gold from which it is made. This next slide is one of the finest examples of Celtic art dating from about 75 BC, and is even more spectacular than the Alfred jewel, and nearly twice as old. It is the Great Talk of Snettisham in Norfolk, and that can be seen in the British Museum. It is one of the most elaborate golden objects made in the ancient world. Not even Greek, Roman, or Chinese gold workers made objects of this complexity. It is made from a kilogram of gold mixed with silver. It has 64 separate threads bound together in 8 separate ropes. Each thread is just under 2 millimeters wide. Nowadays we have machines to do that, but the accuracy for something made with very simple tools is astonishing. The ends of the talk were then cast and welded onto the rope ends. The detail in the casting is equally incredible. Who can look at that and not understand that the gold and silver, capable of being wrought into objects of such great beauty, are immensely desirable and are worth acquiring in exchange for goods? If you've seen Tutankhamun's gold mask in the Cairo Museum, you will also know this. It is over 3,000 years old, and it is as bright and shiny as the day it was made. Everywhere, even in the New World before it was discovered, the human race in Central and South America, completely independently from the known world, shared an understanding of the fundamental value of gold and silver. That is why these metals have always been the money of society's choice. So when we trace back our use of gold and silver as money, step by step back to before it was money, we can see it has a definite inherent value. Money cannot last unless it survives this test. And if money cannot survive this test, its value is based on confidence alone. And that is why every money substitute has eventually failed, without exception. This understanding was what the great Austrian economist von Mises described as the regression theorem for money. Now let's apply the same regression theorem to paper currency issued by governments. Paper currency pretends to go back to gold and silver. Paper currency started off as a money substitute, a gold or silver receipt if you like, more convenient for transactions than physical metal. It was not long before banks issued more money substitutes than they had gold in their vaults. And so long as people believed their paper receipts were as good as gold, the banks got away with what amounts to fraud. And when governments took it upon themselves to monopolize the money substitute business, they continued the pretense. Issuing money substitutes was and remains to this day the easiest source of government revenue. But government currencies, these money substitutes, have now lost their regressive value entirely because there is no right of conversion into gold. That was progressively done away with in the United States, for example, firstly by executive order in 1933, which banned US citizens from owning gold, and finally by President Nixon in 1971, when the United States stopped exchanging paper dollars for gold with foreign central banks. Nixon reneged on the Bretton Woods Agreement. From then on, there has been no convertibility at all. This next slide shows how important this event was. This is Austrian or true money supply. That is to say, cash, deposits, and checking accounts that are instantly realizable as cash in US dollars. To this I've added the excess reserve balances held at the Fed, which can be drawn down by banks at zero notice and deployed in financial markets. You can see how the quantity of dollars started accelerating long before the Nixon shock. I don't know if you can see the dates on that. I can't make it any bigger, unfortunately. but the blue line starts around about 1959, so that'll give you some sort of idea. Yes, you can see how the quantity of dollars started accelerating long before the Nixon shock, which was in 1971, as I said. And it was that acceleration, first to pay for the Korean War and then Vietnam, that led to surplus dollars in non-US hands. And it was those dollars in the hands, particularly of the Bank of France, which were exchanged for American gold at $35 per ounce. It was effectively a run on the US Treasury. True money supply grew exponentially from the late 50s, but then went hyperbolic after the banking crisis. That dotted line is the exponential curve, as it were. So it's going faster than that. And this is not just true of the US dollar. The Bank of Japan, the Bank of England, and the ECB are all expanding their balance sheets at unprecedented rates. For money to be truly money, everyone has to recognize that money is sound, passes a regression test, and cannot be corrupted. Otherwise, it cannot be retained or held onto for the purpose of future transactions. And whether money is simply hoarded or made available to someone else for future repayment with interest, the savings process, which is fundamental to society, depends on money not being debased. Gold fulfills the required conditions. Its supply relative to the above-ground stock grows at about the same rate as the world's population, giving an overall constancy. It is universally accepted as money, in contrast to fiat currency, which only acts as money substitutes within the legal remit of the issuing government. The fact that gold has been driven out of circulation by paper currency does not invalidate it as money. Rather, it is evidence of Gresham's law, where given the choice, we would rather spend the bad money than the good. Instead, we're compelled by law to use government currency. It allows governments to steal our savings through debasement. The purchasing power of our earnings is also stolen through debasement. Business accounts lose their meaning. We're encouraged to borrow because we know we won't have to pay our creditors back what we originally borrowed. We profit from the difference between what government currency was worth and what it will be worth. In short, the whole basis of economic calculation is completely undermined. The money printers make up stories, telling us that it is all for our own good. A lower currency is good for business, good for the country. What they omit to tell you is your wealth is being transferred from you to the government. They tell us low interest rates stimulate the economy. They don't tell you that by tinkering with interest rates, they set off a credit-driven boom that always ends in a bust every time. The Keynesians and monetarists rely on the debasement of government money through monetary and credit expansion. It is these quack economists who turn round and tell us that the gold standard is a barbarous relic. They say we have moved on from gold to a higher plane of central banking and monetary control. So if paper currency fails the regression test, what's behind its value? Why do we accept it as money rather than for what it is, just a fake substitute? This question gets to the nub of the problem. The answer is, it is wishful thinking on our part. We want to believe in it. We cannot handle two price variables in a transaction. We need the sheet anchor of an objective price for the medium of exchange, so that in our minds we can value what we buy, goods and services. And even those of us who are savvy enough to know currency is being debased still talk of prices rising, not money falling. So if we want to believe in money substitutes, such as government currency, why and how is currency actually valued? We know the why is because we want to believe in it. In other words, its validity is based solely on confidence. The how is answered in the foreign exchange markets. Foreign exchange dealers value all currencies other than their base currency subjectively. In other words, a dealer acquires foreign currency with a view to converting it into his own. It has no other practical use for him. So the true determinant of the value of government currency, so long as its users continue to accept it as money, is a subjective value placed upon it by currency dealers. And when that confidence goes and people realize that it's the currency that's going down and not prices going up, then it loses its function as money. A flight to get rid of it develops. Von Mises's crack-up boom, if you like. What has happened is goods have become the objective constant in transactions and currency the subjective variable. So the question that we've got to answer should not be, will gold become money again? It has always been money. The question now is not, will gold come back as money, but what is going to happen to government currencies? For if currencies lose the confidence vested in them, gold and silver will return to their monetary use. So let's briefly look at the prospects for paper currencies. Go back to that one. It's a bit scary. I quite like leaving it up to prove a point, if you like. So can the accelerating trend of currency issuance shown in that chart of US true money supply be stopped? The dominant currencies are the US dollar, the euro, the Japanese yen and the British pound. All four issuing central banks are increasing the quantity of their currencies in circulation dramatically, and all at the same time. The stated reason is to stimulate their economies. The real reasons are twofold: to fund government spending and to fuel demand for collateral assets so that the banks can maintain the fiction that they are solvent. Let's look at what's happening in Japan. They have 1 quadrillion yen of debt. That's 1 followed by 15 zeros. The government's credit is maxed out, so they are accelerating monetary creation. They call it Abenomics, but that's, forget it. They're just accelerating the monetary creation to pay the bills. Forget economic recovery. It's because the government refuses or cannot cut its spending. And with the elderly in Japan now spending their savings, there is not the money to buy enough government bonds. Worry about Japan, because we are on course to do the same thing. Before concluding, I want to address one question that is often asked, and that is, will a gold standard be reintroduced? If by a gold standard it's meant that there be introduced a degree of convertibility, I think that is very unlikely. Firstly, it limits the politicians' ability to finance their spending and keep the banks they have licensed from collapsing. Secondly, not only do we know they have not enough gold for this to be practical at any price, below multiples of thousands of dollars per ounce, but there is increasing evidence that the Western central banks have leased, swapped, or sold most of what's left into the market. Third, a significant rise in the bullion price would bankrupt the entire bullion bank community. Fourth, there is no willingness to hand financial power to the Chinese and Indians who have had the sense to hoover up all available supplies. And last but not least, all those Keynesian and monetarist quacks fight tooth and nail to ridicule true money because they are intellectually committed to government currency. I've got one last thing to say about Bitcoin. It should now be clear to you that Bitcoin does not pass the regression test. We cannot say that there is a lasting basis for it to be money. Let me put it another way. If, or rather when, governments make it impossible to use Bitcoin for the exchange of goods and services, would Bitcoins have a value for any other purpose? I can't think of any. So on the regression test, it is not suitable as money. In a nutshell, it is this knowledge about what money actually is which led to the establishment of gold money over 10 years ago. We were fully aware of the neoclassical fallacies behind today's currencies, and it was obvious on the basis of sound economic reasoning they would one day become worthless. The events since the banking crisis have given us some timing on that. And the examples of Japan and the hyperdrive behind US dollar creation tells us that day is now only a year or two away. So gold money provides an escape route for their customers into true money, gold and silver, held outside the banking system, with the ability to hold it in stable jurisdictions beyond an individual's government's direct control. Thank you, and I welcome questions.
I know that was a lot to digest. I've got lots and lots of questions and lots and lots of technical terms which I think need, Peter first. Microphone.
We've seen a lot of volatility recently in the gold market, crash, you can say, twice, I think. And well, I personally believe that I'm not concerned about this. I own some gold myself. But I'm always struggling to come up with answers why there is this volatility, why gold has gone down even to the level of the beginning of 2011 in the face of these enormous expansions of the balance sheet of the ECB and the action in Japan. That was very strange to see at the moment when Japan announced to double its monetary supply, and when you see gold skyrocketing in Japan, to see gold actually going down in euros and dollars. So my question is, how much do you believe in these theories of manipulation, in the sense that that's the sort of the most plausible theory I always hear, that they basically expand drastically the paper gold market, and thereby you would have to make a difference between the paper gold price and the physical gold price. But when looking at the premiums, like at the local dealer here in Brussels, these have gone up, but not dramatically. And then there's this big mystery, maybe second question on GLD, you know, the biggest gold tracker, I think. People claiming that when everyone who owns GLD asks for the physical gold behind it, that there's only like 5% or something available. So do you think this is credible or all crazy conspiracy theory? Thanks.
Okay, several questions there. The first one I want to deal with is the situation in the market. I mean, you're right. In April, it was hit very hard. The bullion banks operating on COMEX were short of both gold and silver. They had to close those positions. They understood, I mean, they understand what actually is going on in the banking sector. And they see risk. And they can understand also that in the wake of the Cyprus trouble, what had happened was that there was quite a lot of demand moving out of bank deposits into physical gold. And worse than that, for the bullion banks, customers wanting their gold back so that they could store it privately. So they had to stop the run, if you like, of physical on the bullion banks in London. And that explains why they hit the price. Now that then threw up something very interesting because, yes, you know, all the technical levels were broken and all the rest of it, and that explained everyone who is an investor in gold that there was a bear market and therefore get the hell out of it and wait another time maybe. So they managed to get quite a lot of stock out from liquidation of things like GLD and to a lesser extent SLV, though that's held up very, very well. But what happened on that was very interesting, because price theory would tell us that if the price of something goes down, then it increases demand. And that's precisely what happened. All the buyers of physical came out of the woodwork, not just in China and India, but they had, you know, they ran out of supplies in America doing, you know, golden eagles, I think they're called. Everywhere, suddenly there was huge, great demand for physical, and they've cleaned out the markets. And if you look at the deliveries on the Shanghai Gold Exchange, they have ceased because there is none available at this price. It's actually as simple as that. So what that move actually showed was that you've actually got two players in the market. I mean, we see it in the sense of paper and physical, but it's probably better described that Western capital markets, who drive opinion more than anything else, follow, if you like, a neoclassical approach on this. They do not understand that gold is actually money. They think dollars is money. They think that gold is some sort of, you know, risk hedge asset, which sometimes is worth playing, sometimes is not. So they don't actually take gold as seriously as they should. And then, on the other hand, you've got the other side. You've got the guys who, quite simply, can see what's going on and are worried about the future security of their savings. And so they want to take out some insurance against that. Now that, again, is still a Western approach. If you look at it from the point of view of an Indian, I mean, I first went to India in 1966, and someone of my age then, young man, let's say he sort of got married, you know, the dowry that he would have got from his wife's parents would have been gold. His savings habit ever since then is all in gold. But when he got married, an ounce of gold fabricated into fairly rudimentary jewellery probably cost no more than 180 rupees an ounce. It has been as high recently as 95,000 rupees an ounce. It is currently about 80,000 rupees an ounce. You're not going to be able to persuade the average Indian middle-class man that there is any better way of protecting his assets, his liquid assets, if you like, his non-business assets, than actually owning gold. That's what it's all about. And that's why, when they saw the price go down, I mean, they just wanted to stock up. And so that's the answer on the market. Now, you referred to GLD. I actually wrote some time ago to the FSA, Financial Services Authority, about the custody status of GLD and SLV, because there are all sorts of rumours in the market about how there was a conflict of interest and the custodians were short of gold and silver on COMEX, and they were probably using this as a slush fund to deliver, and, you know, all the rest of it. I mean, we've all read the rumours. It took me a long time to get an answer out of the FSA, and eventually I got a sort of Panglossian answer, which basically said, we have passed your comments on to the custodians involved. Now, shortly after that, their prospectuses were changed. They were no longer effectively regulated by the FSA, but they were working under the dealing and settlement practices of the London bullion market. Now, I don't know, I'm not an expert in these things, but I do know that with gold as a fungible asset, I do also know that the standards are less than the FSA wanted of their custodians. And so it is inherently an unsatisfactory thing. Now, I can't turn around and say that we're presented with a bar list, which is a complete fiction, because really what you're doing is you're saying that the custodians are committing fraud. But all I would say is there is a lower standard of custody regulation for GLD and SLV than probably most of the owners of those ETFs actually understand. And I would leave it at that. Meanwhile, there's no doubt that those investors, and I define an investor as someone who starts in his currency, goes into an investment in the hope of profit, which he's going to realize back into his own currency. GLD has got a lot of investors in it, and they will have seen the change in market sentiment, and they will have changed their opinion along with it. Yes, I can understand that GLD, quite a lot of GLD has been liquidated. Equally, there will be holders in GLD who are aware of the stories that have been going round, will have seen the deterioration in the situation in the banks, and they would have been prompted perhaps to think, well, I better get this under my own control and have it somewhere where I feel that actually my gold is there, rather than, you know, interposed by paper, which I don't actually fully understand. I hope that answers the questions.
Roger. Well, thank you very much. Yes. I've got a couple of quibbles and a real question. The quibbles would be, you say money is always the same today, yesterday and tomorrow, and you say gold is money.
It should be.
But manifestly it's not, because we've seen the price of gold change, and if you don't like expressing it in terms of a fiat currency, you can express it in terms of a basket of goods that you might be able to buy with your gold. So to that extent, gold does change. Equally, you say money doesn't have a price, but if you define gold as money, well, you could have a price in terms of silver, you could have a price in terms of a fiat currency, you could define a price in terms of some other commodity, like oil, for example. You know, how much oil do I have to give if I want a kilo of gold in exchange? Those, as I say, are quibbles. The other point I'd make to you is this, though, that, I mean, how many people hold all their wealth in fiat currencies in a bank account? I would think they'd be extremely foolish to do so. I mean, your average sort of person who's accumulated a certain amount of assets in the course of his lifetime is probably going to have a house, he's probably going to have some unit trusts, and those real assets, if the value of the fiat currency goes down, the value of the assets will go up in terms of the fiat currency, just as the value of the gold will go up. So, I mean, would you recommend somebody to sell their house, rent, and take the money they've realized on the sale of the house and put it into gold? And would they be better off than leaving it in their house?
Right, okay. The first thing I would say is that I was presenting to you the theoretical relationship between money and goods. I'm not saying that's actually how it works. It works like that for us with paper currencies when we do a transaction. I mean, when you go down to the supermarket and you go shopping, as far as you're concerned, you're spending money, which is the same value when you did your supermarket shop the previous week. And the test in this is that when you see the price of butter has gone up another 20 cents, you think, God, bloody butter's got expensive. You don't actually think money's gone down. Yep. So I think that's the distinction I would make. The second point about the gold price being volatile, gold is not used as money. It has been driven out of circulation, which is why I mentioned Gresham's law. And there is obviously huge volatility in the price. I mean, it's what we were talking about, you know, with that sort of hit in the last month in particular. But actually, if you really do understand which is money and which isn't, which is masquerading as money, you should look at it the other way up and say it's the dollar that's beetling around, not gold. Now, that's completely impractical because you don't go into a shop and say, you know, here's some silver coins, Krug around or whatever to buy what it is. So in a sense, I was trying to get the theoretical point over so that you could understand the true difference between real money and faux money, if you like. You make a point about nobody holds all their investment in cash, in currency cash. Yes, that's undoubtedly true. But the reason for that is that we all know, in spite of the fact we go into the shop and, you know, what we spend, you know, we see the prices go up compared with what we did last week. We all know that government currency erodes in value over time. So you know that the one thing you don't want to do is to leave it on deposit, and particularly when the central banks sit on interest rates and reduce them down to zero, you particularly don't want to sit on cash because it's just a waste of time. And you also know that what's happening is that the effect of that is to drive money out of deposits into speculative assets, whether it's stocks, shares, government bonds, whatever it is, which are all priced on the back of interest rates, not on the back of their use value or the income that they can produce, just purely on the back of lower interest rates. So, I mean, yes, you do have to do that from a practical point of view. But behind that, when you go out and you buy something, the other side of it in the bank's balance sheet is a deposit. Or if it's not a deposit, it's a bond, which again is like a deposit, except it's got a term on it. So you can't say that everyone can get their money out of banks and put it into a property or stocks and shares or whatever, because that money then goes back from whoever you buy it from and goes back on deposit in the banks. So, you know, someone ends up holding the can. And the thing that is so unjust about government money is that the people inevitably who end up holding the can are the people who cannot take the risk of diversifying out of cash, the old, the infirm, the people who need an income. And they are just completely stuck. And that, I think, is the true injustice of money printing and the debasement of currency. Yes, Richard.
Richard Biffle, and a quick question. I read this week that the Belgian central bank has lent out 10% of its gold to bullion banks. And could you tell us a bit about the other central banks? Do they disclose any data on this? Because the only I have seen is from Belgium. And does it factor into these stories about manipulation of the price? your comments.
Okay. Yeah, I saw that. A number of other banks have admitted to doing this, by the way. I think I'm right in saying that the Austrian Central Bank produced a series of statements under pressure about its gold position. And in an unguarded moment, the head of the central bank said, well, we've actually, done quite well because we've paid for all the storage fees by leasing out our gold. Oh! There was a sort of, then they sort of tried to go quiet on that. I mean, the answer basically is that when gold is leased, it gets sold into the market. The whole objective of leasing gold is that it backs the carry trade. But because gold has been driven out of circulation and doesn't operate as money, it basically does not, if you like, accrue or attract any interest on it because you haven't got that use, if you like, as money. There is a low level of interest, yes, but it's so low as to be impractical to call it an interest rate. It's more a lease rate, if you like. So what you can do is you can take gold from the central bank, give them a very, very small interest turn on it, sell it into the market, take your proceeds, invest it in government debt, spin 4, 5, 6%, something like that. That's what they were doing the whole way through the 80s and 90s when the returns were at least that and very often more, by investing, say, in 6 months treasury bills, whatever it was. And then at the end of the transaction, you close it down and you've got a very nice profit. I mean, it was a fantastic business, that carry trade. But the trouble is that when you sell the gold into the market, it all disappears off. Either initially it was going off to the Middle East and India, and then when India actually sort of turned around and became freer with foreign exchange and capital controls and all the rest of it, that accelerated, or at least it came up above the radar screen. And then China from 2002 then really started building its demand, and that demand is still building. So it's actually very difficult to see how something which probably started off as a very good means of financing government debt by selling gold into the market with a promise to sort of get it back, very difficult to see how that could come back. And I think probably what's happened is that a lot of the return gold, as it were, either hasn't returned, or if it has returned, it is returned by gearing up the balance sheets of the bullion banks. In other words, the bullion bank stock has been used, if you like, to come back. Really, I think the idea that a central bank leases out its gold, I think is absolutely crazy. Because from the point of view of central bank accounting, ownership has not changed. But the fact of the matter is that the central bank no longer has that quantity of monetary gold. It's actually as simple as that. So this has been one of the tools whereby the Western central banks have managed to suppress the price. And, I mean, we hear all sorts of stories about, is the gold still in Fort Knox and all the rest of it. And I think there have been, apart from various statements which have indicated that the central banks have indeed been selling gold, there are two things which we've discovered recently. One was a Canadian called Eric Sprott, who you may well have heard of, who went through the import-export statistics for non-monetary gold for the United States and established that there appeared to be a minimum of 4,200 tons seemed to come out of thin air. Once you take into account, sort of jewelry recycling, American mine production, imports into America, there's 4,200 tons minimum, probably as much as 11,000 tons, which they couldn't account for. That must have come from the central bank. The second bit of interesting information, I think, it was something that I turned up. I had a look at the Bank of England's accounts, and I think from about 2005, they started putting in their accounts an amount of gold which they have in custody. And if you marry up the figures with what has been happening with changes in other central banks' gold, because, I mean, the assumption would be that this is monetary gold held on behalf of other central banks. In fact, there has got to be a minimum of over 2,000 tons of their 5,000 odd tons is not monetary gold. So what's happened is that that has been sold by central banks, and it has been acquired, for example, by governments, government wealth funds, and to a very, very small extent, there may indeed be some bullion bank gold held there for, as either collateral or self-custody. But it is clear that there is less gold around in the central banks than the central banks say. And the final comment I'll make on that is that it seems it's going to take the Bundesbank something like 7 years to get part of its gold back from the United States. Why? They could do it in one flight with an aeroplane. Well, probably 2 or 3, but, but that's it.
Thank you. I'd just like to welcome Godfrey. Would you like to chip in, Godfrey?
I say apologies for being late. The only thing I really wanted to hear was this. In 8 years, everything else here is bullshit, and I managed to be late, but never mind. I know your views very well and sympathise with them. Have you covered, and I do apologise if you've covered this, but I think perhaps you won't have done yet, could you talk a little bit about gold in the ground and the reaction of gold stock prices? Because I was looking at a chart the other day, which I've got in my case, which I might bore you with perhaps after the meeting, looking about stock prices, gold share prices vis-à-vis the cost of production, which I think is averaging about $900 an ounce perhaps, but I'm not going to nitpick on figures. It would suggest to me that, as an ex-city man, that this is an opportunity. At the moment, gold in the ground hasn't moved. You know this, I know this, we all know this. Everybody who takes an interest in this subject knows this. And if ever there was a buying opportunity, I'm sorry to be vulgar about making money, but I like to make money if I can, I'm sure we all do. What is actually happening to gold stocks and gold in the ground? And surely, if we're seeing a physical, a very big question mark over the physical supply of gold, and you can buy it, perhaps you might argue, at $900 in the ground, is that going to happen or not happen, or where are we?
As a stockbroker, I used to follow gold shares very, very closely. I don't follow them quite so closely now, but I think I could probably make some general comments, which I hope won't be taken as investment advice. Yeah, I mean, firstly, what has happened really over the last 10 years in particular is that the quantities of gold being mined have increased generally in Asia, and particularly Russia, the various stans, and China, and it's diminished very noticeably in South Africa. The cost of extracting gold in the West, if that's what we're going to concentrate on, certainly has risen. And furthermore, gold mining companies have had huge problems raising the capital to develop new mines. It takes a long time to develop new mines. It can take 10, 12 years, basically, before a mine, you know, from planning to actually getting the thing up and running. I would hate to say that we've sort of peaked gold. In fact, I think in about 1898, there was sort of concerns that there might be not enough gold for the expansion of economies generally. I mean, it's sort of a pre-Keynesian analysis, if you like, of what was going on. But actually, the amount of gold that has been the largest amount of gold that has been mined has actually been recently, over the last 15, 20 years, I suppose, really since cyanide leaching came in. So the means of extraction have improved hugely. I think that in terms of the supply, nobody has found any really decent quantities of gold in the ground for some considerable time. It's really a question of working out existing mines, and the new mines that are being discovered tend not to be really mega. I mean, not like, you know, the Rand, not like Yukon, not like California. I mean, there's nothing of that scale in sight anywhere. I suspect there is a lot of exploration to be done in Africa. I suspect that there is a lot of exploration being done which we're not privy to in Central Asia. I suspect that once we're booted out, there's going to be a lot of interest in Afghanistan, for example. The whole of that area, I think, could potentially be quite gold-rich. But the problem is that unless you're, say, the Chinese state or the Russian state or the Kazakhstan state or whatever, if you're going to rely on markets to raise the money to develop these things, then there is so little interest that these developments, I think, are, they just ain't going to happen until the gold price really goes up and there is some real capital available for them. Your general question about, which really boils down to, is this a good buying opportunity? I think, personally, I believe the answer is yes. It has to be. But I would draw a distinction between something I was referring to earlier. You've got to think in your own mind, am I investing in gold? Am I an investor? Or am I looking to protect myself against a systemic crisis? If you're looking to protect yourself against a systemic crisis, then actually you should have the physical. If you're an investor, in other words, you're buying something with a view to selling it at a profit at some stage in the future, then I think gold mines, or probably better, a royalty play, is a very, very good investment alternative. I think that's about all I can say on that subject, Godfrey, really. Any other questions? One here.
Hi, my name is George Markopoulos. I'm Greek, and I have a question. I was a young engineer in the 80s when Russia invaded Afghanistan. The price of gold at the day before the invasion was $580 an ounce, and the day of the invasion was $850. This is a 50% increase. If something similar happens, say, the US invading Iran, are we up to see something similar happen, i.e. gold going from $1,400 to $2,500 an ounce?
It's a very good question. In fact, I was around at the time when, as a stockbroker, when gold hit that 850 level, and I hadn't really made so much the Afghanistan connection. More, I think the Shah of Iran was deposed at about the same time, and I think that was certainly one of the peaks. I can't remember. There were two price peaks, and one of them was when Iran blew up. So it was interesting that you were sort of bringing in Iran again today. I don't honestly know the answer to that question. Gold is very much a manipulated market. I would expect the Western central banks to try and stop the price of gold going up on an event like that. Whether they succeed or not, I honestly don't know. I really don't know. I think to my mind, what is far more important, rather than individual events like that, is the assessment as to whether the financial system we have today is going to survive or not. And I think that should really determine whether you own physical gold or not. To me, that is far more important. And my personal view on the current financial system is, as I said in my lecture, I think we've got very little time left. It is in very, very dangerous straits. I mean, look at it this way. We have a situation where we've now got zero interest rates. Money, understandably, has begun to move out of things like bank deposits, where you get absolutely nothing, into assets. We're getting an asset bubble. We can see stock markets hitting new highs. We can see property prices, even in America, beginning to sort of perk up. You can see that there's everything there which tells us this is an asset bubble. Every time this happens, the next stage is money starts coming out of the assets and going into physical goods and services. And the reason it does that is very, very simple. Interest rates start rising, either because we begin to anticipate that inflation is going to pick up, or very often what happens is that inflation actually does pick up. And then suddenly, the central bank policy of keeping interest rates at zero cannot be maintained. Now, this is desperately important. We have so much debt in the public sector and the private sectors that we cannot stand a ramp in interest rates to control inflation. The Volcker option is not on the table. So there is no way out of this current problem, as I see it. I don't think that any central banker, well, when I say any central banker, in the four big central banks producing the dollar, the yen, the euro, or the pound, has got the balls, if I can put it that way, to actually stop monetary inflation. They cannot stop it. And on that basis, that to me is actually the fundamental reason that you should be buying gold, rather than, let us say, something like an event, whether it's whether there's another OPEC hike or, as you rightly say, something to do with maybe the Syrian situation, because that certainly is is a developing situation. Any other questions? Sorry. Yes. Do you want to follow up on that? Sorry.
No, I just had another question on your advice to buy gold. In which form? Should it be in bars, in coins, because if there will be a systemic crisis, then I suppose that it might happen that we would have to use this gold as money. So should it be in, I don't think that one would be able to go with a bar of 1 kilo of gold and try to buy something.
No, so, and not only that, but when you get a collapsing paper currency, essentially it will impoverish anyone who has paper currency and assets which are dependent on the value of paper currency. So, I mean, basically, if this happens, you're going to need some small change. And silver would certainly be very, very useful in that respect. Really, what I would see is that the wise person would have the bulk of his money, if you like, in proper money, in gold or silver, held in a vault, identified as his, not through a bank, but separately. I mean, you can either go directly or through someone like us who can arrange that for you, and have some loose change, if you like, for your everyday needs. Because the disruption from a currency collapse, I think, is something that is, it basically means that people are going to starve if it happens. It means that the community within which you live is going to really face huge deprivation. And you're going to be one of the very, very few people, if you've had the wisdom to anticipate this, to put yourself in a position where you can help these people. So you've got to take that into account as well. You can't stand back and say, I'm just a hermit. I'm not, we're all part of a society. We buy and sell things from each other. That is what society is. It's not government, it is us. And it's going to be very difficult if it happens. I pray it does not happen, but I cannot see the circumstances where it is going to be avoided. That's the important point. Sorry, there's a question there.
So in your presentation before, you mentioned that Bitcoin was shut down because there was some pages blocked, like Mt. Gox and some other platforms. But actually, Bitcoin isn't depending on Mt. Gox or any other specific platform. It's true, it's dependent on having some platform available, but not on having any specific platform. And actually now there are so many platforms that even if you shut a few down, it can easily continue working. And even if you shut all of them down, there can easily just be created a new one. So actually you can shut Bitcoin down by just closing some platforms. As long as there is internet, there can be Bitcoin. So the only way to really put an end to it is if you shut down the whole internet globally. And I don't think that's so likely to happen, so I don't really see that you can shut Bitcoin down the way that you claimed it could happen.
Okay. Well, firstly, what I said was that there was one that effectively is being shut down, and that's Mt. Gox. And the way the governments hit it is not by outlawing Bitcoin, but the way they hit it is they stop you converting your money out of Bitcoin into dollars or whatever it might be. And it's at that point that you're stuffed. And They haven't done it yet. They've hit another thing. I can't remember what it's called. It's something exchange, which was, sorry? Liberty Exchange, thank you, which actually was a different thing. But that, to me, was very much the warning shot, if you like, across the bows. In policing terms, it's actually very, very simple. The US government just leans on you. They will lean on a bank and say, you cannot take money from these people, because otherwise we'll come round and we'll inspect your books, and we will try and establish that you really know that this is not the proceeds of crime or the proceeds of tax evasion. And no bank will touch any transfer in from a Bitcoin exchange face, if you like. So I'm not saying that's happening yet. I think it's quite likely to happen that way. And I think the Liberty Exchange thing, to my mind, was, I thought, well, this is interesting, watch out. That's all I'm saying.
But I mean, as long as you have just one single bank on planet Earth, you can still do it. And I mean, there are more than just one bank that is willing to do this exchange now. So again, I don't see it so likely they shut it down. And also, now Bitcoin is becoming so common that you don't actually need to exchange it for dollars or euros or anything to trade. I mean, I've seen houses and cars sold for Bitcoins, not exchanged to dollars and then sold. No, sold for Bitcoins. So now you can actually trade a lot just with Bitcoins or amongst the different cryptocurrencies that are available online. So I mean, the whole exchanging things to fiat currency is becoming less and less normal if you trade with Bitcoins. You can begin just to buy products and services directly now, and in the future it will be probably even more so. So I mean, I don't even see people, you know, who are into Bitcoin would like to have those fiat currencies in the future if they can just trade directly.
Well, I hope you're right, but all I would say is watch out. I think we'll have to leave that one there. Any other questions? Yep.
Hello, my name is Vincent Denis. I work for Mike Maloney's company, goldsilver.com, and I have a question for you about safe havens for gold storage, actually. Do you have any favorite location, personally, from a personal point of view, maybe? Is it more like Hong Kong or Singapore? What would you recommend for European Union citizens as a safe haven for gold storage outside the EU, I mean?
Yeah, well, I think the first thing I would say is that to have your, the bulk of your gold and silver stored out of your jurisdiction where you live is the most important thing. What we're sort of moving on to, in a sense, is another question, and that is it possible that the G7, G10, G20, whatever, going to turn around and stop people dealing in gold and silver? And I think that's unlikely. And the reason I think it's unlikely is that I suspect the price effect would be to drive the price up very sharply. And that would be handing a huge, great strategic benefit to the Chinese and Russian governments in particular, and all the residents of the, sort of, if you like, the gold-loving Asians in those countries and elsewhere. So I don't think that's likely to happen, but you never know. So that's the background against which we're discussing this. I mean, we have storage facilities in Canada, London, Zurich, Hong Kong, and Singapore. And I personally have some in Singapore, and I have some in Zurich. And I haven't really looked much beyond that. Those, to me, are sort of the ones I feel fairly comfortable with. Now, if, let us say, there was a move to try and restrict dealings in or ownership of gold and silver, I don't see that many members of the G10 or let alone the G20 are going to sanction that. So I actually just don't see it as a starter. I mean, can you imagine the Swiss government, who I think now are actually part of the G20, aren't they? They're maybe even the G10, but anyway, they're certainly G20. Turning around and telling its citizens, you can no longer deal in gold. I mean, it's not going to it's not going to work. Not even the German government are going to do that.
They did, if I may say, they did link the euro to the franc, and we all thought that. I thought that was bloody impossible 2 years ago, to my cost.
Yes.
No,
the Swiss...
government won't do.
Yeah.
There's nothing any government
Yeah.
won't do.
I take the point, Godfrey, but I just think that something like ownership of gold and silver is actually so fundamental. It's rather different from doing something monetary. I mean, you can fiddle around with money and nobody seems to really notice too much. Those of us who understand it or think we understand it, we worry about it, but the man in the street doesn't really care too much.
I do apologise for being late. You must have covered the 1930s. You must have covered the appropriation of gold by the land of the free.
Absolutely, yes, yes.
So, I mean, if they could do that, if the so-called free government, you know, the leader of the free world, Franklin Delano Roosevelt could take people's gold coinage at the point of a gun, I'm a little bit surprised at your view.
What I would say is that the situation in 1933 was somewhat different. For a start, FDR managed to have a sort of a sense of crisis, if you like, and get a sort of, if you like, a national imperative to override the Constitution. And he managed to do that. The second point, which actually isn't often mentioned, is that there was some of the paper currency which was endorsed that it was convertible into gold or silver. I think it was gold in particular. And they needed to take that out of circulation if they were going to devalue the dollar against gold. And that's essentially what happened. That is not the situation today. The situation today is very, very different. And it is far more global. And I think that if the G20 tried to go into those sort of measures, it would be seen as a real panic. And I think they would just drive the price up. And by driving the price up, they would bankrupt the bullion banks. And not only that, but they would hand this huge, great benefit in relative terms to the members of the Shanghai Cooperation Organization, who basically are the majority. There are 3 billion people in in Asia, Euro-Asia, if you like. So I think the situation today is somewhat different. But I would still take the view that I actually want to get my gold and silver out from under somewhere where I don't need to worry about these things. Any other questions?
My name is James Ben. I work as an official here in the Parliament, a lawyer, linguist. I'm not an economist, and a lot of this is a little bit over my head, so forgive me if this sounds rather naive, but you were talking earlier about the production of gold out of the ground, and I found that very interesting. It put me in mind of something that my elder sister told me when I was a small boy. She was, I don't know, it may be complete rubbish, but she was talking about diamonds, and she said, do you know, if they really launched onto the market all the diamonds that they quarry all over the world, you could buy a diamond in Woolworths, dear old Woolworths, goodness, for sixpence, dear old sixpence. I was amazed by this, and maybe, as I say, it was complete rubbish what she was saying, but it did instill in me a sense that the value of something is dependent on the quantity of it that is available. Presumably, when not gold supplies aren't going to run out, but the value of gold is presumably affected by the amount of it that's around. And from what you were saying, it sounded as though there's not enough of it around at the moment. Do you see that changing? And am I right in thinking that this quantity factor does affect its market value?
Well, well, quantity obviously does. I think the way to look at it is that there are, on our estimate, just under 160,000 tons of gold above ground. We don't know where it is. I mean, we know where some of it is. I mean, I know what I've got. It's a very, very small part of it. But beyond that, we don't know what governments have got. I mean, the Chinese, for example, we can be pretty sure, have been taking all their own domestic mine production and stockpiling it. They haven't been stockpiling it as monetary gold. It hasn't appeared in the central bank's accounts. I mean, I think they last updated, it was something like 2008 or 9 or something. They jumped it up suddenly to 1,050 odd tons. But, I mean, that figure hasn't changed. And my sources tell me that actually you've got to look at what the Communist Party are doing. That's, you know, they're the ones who are accumulating it. So this actually brings us on to a point. You have to look at gold in pricing terms as not a market of mine supply of 2,700 tons, scrap recycling another 1,200 tons on top, which is roughly what the figures are. You should look at it from the point of view that here is a huge, great stockpile of 160,000 tons. Now, this is important because on any price move, what you're doing is you are mobilizing opinions, not on 2,700 tons, but on 160,000 tons. We're talking about some pretty big forces. If let us say we suddenly had another wonderful gold find, it's not going to make a huge difference. The analysts will tell you it will. They'll say, well, this is, we've now got to find buyers for 4,000 tons, let's say, instead of 3,000. That's a load of hogwash. The whole time you've got to look at the market not on that annual addition. You've got to look at it in terms of there's 160,000 tons out there, and that is what's being mobilized on a price change. I found your analogy with diamonds quite interesting on one level, because my grandparents retired in East Africa, and when my dear old granny came back, there were capital controls. You couldn't get anything out of East Africa, out of Kenya. What people did was they bought Persian rugs, because those were sort of seen as household possessions. So you could get a sort of reasonable Persian rug, but I mean, the price of them in Kenya was kind of high for really what they were, for obvious reasons. But what dear old Granny did was she had 2 diamonds, which my grandfather had bought in the 30s from an expert in diamonds, and we auctioned those eventually in I think it must have been about 1980, something like that. And they fetched about £40,000. I mean, these were proper rocks. Cut was slightly old-fashioned, but she felt that she could sew them in the lining of a thing. So that is interesting, because when things get really bad, things like that suddenly do take on a value of their own in that very practical sense. Diamonds as a whole, the price has been controlled, or was controlled for many, many years by the De Beers, effectively, who ran a complete monopoly situation. If they didn't run that monopoly situation, I have no doubt the price of diamonds would have been somewhat less. But even then, you're back to what I was trying to get over with gold, that there is a fundamental value in these things. You look at it and you want to have one of these things. You may not be able to pay, top dollar for it or top euro for it, but it is a desirable thing in its own right. So it actually does have that fundamental value. And it has, it's not practical to have it as a currency, because there's too much variance in them, size, quality, and all the rest of it. I mean, you have to be an expert to understand these things. So it's not actually a practical money. But the one thing it does have is something that gold has got. It's got that, you go back to before gold was money, and you can look at the Snettisham talk and you think, God, look at that. Isn't that fantastic? I want some of that. And that is true also of diamonds.
I wonder if I might add a sort of sub-question to that, because I've got a lot of sympathy with the gentleman who's... is that a Corpus Christi tie? No,
I'm afraid it's tie rack or somewhere.
Oh, right, okay. I'm pretty sure it's Corpus Christi, but that's neither here nor there. Your sister wasn't far away, and I think perhaps, could we draw, maybe, I don't know, diamonds isn't my specialist field, but there is a controlled market, of course, by De Beers, as we've all known, and has been so for many years. would you perhaps not argue that there's a corollary here between Wall Street exchange-traded funds, paper gold, which is being controlled indeed by arguably Wall Street or the international banking system, influenced by central banking, with the difference that it's easier to judge how much physical gold there is on the planet, rather more easy, than it is diamonds, which is slightly more ephemeral commodity. Or am I missing a point somewhere?
No, I think you've got a very good... In fact, well, you make several points, Godfrey. I think you are right insofar as there are large diamond pipes, I'm sure, yet to be discovered, on the one hand. On the other hand, I think what the comparison you're making between De Beers and the central banks and the bullion banks, I think, is absolutely right. Yes, they are controlling the price of gold. They did not want one of the. I think you were here actually when I answered the question about what had happened in the wake of the Cyprus mess. It was quite clear that quite a lot of people went to their bullion banks and said, well, I want my gold. And this got to the point where ABN AMRO allegedly had to write to their clients and say, sorry, mates, if you want your gold, you're going to have to take cash. So this is, there is no doubt that there was a run developing on the bullion banks, and they needed to take the bullishness out of gold. And that's really what the smackdown was all about. And I think it was not just the bullion banks. I think the central banks were probably involved as well. I'm convinced of it. I've got no evidence of that. Someone asked me, I think it was Max Kaiser, asked me about, there was a sort of 400 or 500 ton order in the market on COMEX. Was that a central bank? But actually, if you look at it, 400 or 500 tons, if you're a hedge fund and you can put down $1 billion as margin, you could produce a synthetic sell order of that sort. And, given that hedge funds are run by, sort of, if you like, neoclassical, economically trained idiots who think that they know it all, it wouldn't be surprising. That's a philosophical question. But anyway, the point is we actually don't know who has been, who is actually intervening at any one moment. But what we do know is that the vested interest very much is for the central banks, and particularly the US central bank, not to have gold appearing in people's minds as a rival to their paper currency. Any other questions? Have I exhausted you? I'm sorry about that.
Can I just jump in? I think we've had a good bash. I hope I can put it like that. We are over our time, but if there's one more question out there, then I think we can just squeak that in. I think there's the will for it. But I've got one of my own, sort of exercise chairman's privilege. I always hold back. But I'd like to ask two questions. My favourite, just short ones really, my favourite scenario which makes gold skyrocket, because I've got a little bit, is a systemic banking crash a la James Ricard's, because I read his book Currency Wars, and I thought, yeah, I can see this happening. Deutsche Bank or BNP, somebody you think is absolutely the Rock of Gibraltar, so to speak, and they go pop, and everybody worries about who's exposed to them, and vice versa, and the whole banking system locks, and then everybody dives for the gold. And my second point is, when you look at these technical charts and people say there's a support level, so gold, it's almost impossible for gold to go through 1200 because there's an absolutely rock solid support level, and they draw these lines and these graphs. If you think about it, if you go back 2 years to when 1200 was the absolute sort of rock solid bottom and it was consolidated at 1200 for 18 months, well, that was how people felt 2 years ago, or however long it was ago. And sentiment has moved so much that you can't really say that that has any meaning on for today's. What do you think?
Yeah, no, I agree entirely. I'll take points in that order. The idea that one large bank could fail, I think that is certainly possible. The advantage that modern central banks have is that they actually do know what the positions are in these large banks. And to a significant degree, they can cover up a potential failure. So if, let us say, Deutsche Bank gets itself into difficulties, I'm sure that you would find that in the background, well, you wouldn't find because we wouldn't be told about it, but in the background, there would be a lot of toing and froing and making sure that they've got the facilities and it's all right and don't tell anyone. So the one advantage, I think, of that the Fed has, if you look at the derivative positions in the US banking system, it's really concentrated in very, very few banks. So in a sense, the Fed has got, if you like, the ability to control or stop, they've got the ability to stop a derivative crash happening in that sense. To my mind, there are other dangers. I touched on the interest rate danger. That, to my mind, is the big danger, and I think that's going to happen, and I think that it's just a good old-fashioned progression. You print the money, and you print the money usually by pushing interest rates down to create the demand for money, and then asset prices go up, and then at some stage it starts moving out of asset prices and it starts moving into the things that we buy and sell to live on, you know, whether it's energy or food or whatever it might be. It's never quite as clean as that, but broadly, I think if you think in those flow terms, we've got the asset bubble now. I don't know how long that asset bubble is going to drive on. I really don't know. But I know the next stage is it starts coming out of the assets and it starts going into goods and services. And at that stage, either ahead of it or at that time, interest rates are going to go up. And it doesn't matter what the Fed says. And I tell you, they have got no exit plan on this at all. They cannot handle that. If interest rates go up, think what happens to all that collateral on the bank's balance sheets. It goes down. And banks are still geared, I don't know, 20, 30 to 1, whatever it might be. They cannot afford to take that sort of hit. And that was actually why it was so important for the ECB to get interest rates down in Italy and Spain. And they have got them down quite a long way. But again, I think there's only one direction for them to go, generally, and that is up from here. So that crisis is going to come back. And it's all tied on those interest rates. And then you've got the sort of, you've then got the risk that then goes from there, because all banks are interconnected. And where it'll fall over, I think, is the individual central banks, despite the fact they meet every 2 months at the Bank of International Settlements, you know, someone's going to drop a ball somewhere along the line. And they're just not going to be able to contain it. So I think that's a real problem. The second point about charts, I think two things. Firstly, comparing you know, support and resistance and all the rest of it, this is very much an investment approach, really. It's a stockbroker's approach. And it's the way I would look at the shares in a company. I don't think it really applies to gold and silver for the very simple reason that gold and silver are money. The faux money is actually the currencies. You should be looking at the chart the other way up. But nobody does that. And if you look at the chart the other way up, then you're going to say, well, it's really, in effect, the obverse of that, true money chart. And you can see which way paper money is going, currency is going. So on that basis, you know, fine. You know, gold might move $100 either way from here. But if you put yourself in a position where that really matters to you, then I would suggest you're not actually running your affairs as you should be. So anyway, I would discount any sort of chartist or whatever, because we can have, I think if you understand Austrian economics, and I know that there's a big understanding in this room of you know, what von Mises really did, his a prioristic approach to economics, we actually have the tools to understand what's going on. As long as the first thing we do is we dismiss from our minds the Keynesian and monetarist wish list, which is what it is. It's not based on theory, on sound theory. It is wish list. It is opinion. You may as well go to church for all it'll do. I mean, it is It is not in touch with I mean, they're not in touch with reality. They really are not. We do have the means to understand what is going on if we understand what money is about, and that was what I was trying to get over today. What actually is money? It's not currency. It is not currency. That is a money substitute, which is based entirely on confidence for its value. You can't go back and say, well, you know, the great thing about dollars is that I can go and look at them in the British Museum, and God, I want one of those. No, you can't. It's just not, you know, gold and silver, yeah. Diamonds, yes. Paper money, forget it.
Okay, well, thank you very much, and thank you, everybody else, for coming. I hope everybody's enjoyed it. Okay, thank you very much.
I think the cows were a round of applause. Yes.